Okay, this is Vinny Curto of GoldIRARollovers.com, and I have Nathan Pulsifer here on the line from Annuity Straight Talk. And I wanted to interview Nathan and ask him some questions about secondary market annuities. I know it's a topic of interest for a lot of our website visitors, and it's something that a lot of you guys may be interested in as well. So I want to introduce Nathan. Welcome, Nathan. Thanks for coming on.
You bet. Thanks, Vinny. Thanks for having me. I really appreciate the opportunity to share some information with your readers.
Yeah, I'm looking forward to it. I'm going to learn a lot.
Yeah, definitely. Well, secondary market annuities are, it's a real interesting small niche that I've been involved with for a number of years, and just the same as you. With gold and an IRA, it's a pretty specialized niche. So I think this is going to be of interest to your readers, definitely.
Yeah, definitely. Well,
so
what I'd like to do can you give a little background of your experience in the industry?
Yeah, you bet. I was just about to do that. And so again, my name is Nathaniel Pulsifer, and Annuity Straight Talk is the company that I have online that works with annuities in general. But we have found that secondary market annuities are a fascinating niche within the guaranteed income space. And I got to know Vinny through one of my other websites known as secondarymarketannuity.net. I've got a few other websites as well. As my partner and I have grown in the industry, we now serve not only retail investors, but we also serve advisors in a wholesale capacity all over the country. We serve hundreds of advisors and do millions and millions of dollars a month in this particular asset class that we're going to get into here in a minute. So it's been a really interesting ride for several years, and really secondary market annuities came up out of the financial crisis in 2008 or so, and they have come to serve a really important aspect of financial planning to give guaranteed income at a higher yield.
Very interesting. So I guess I can kind of start off with the first question, where you may have already kind of touched on it, but what is a secondary market annuity exactly?
Yeah. Well, a secondary market annuity, there are a couple of words out there, a couple of phrases that different people use to describe this. Secondary market annuity is sort of a trade name that we utilize, but some of your readers might have also heard of in-force annuities, or they might even have heard of structured settlements. And so a secondary market annuity, what we refer to, is it's a payment stream that is transacting on a secondary market basis, kind of like a note or a receivable. Like, let's say you wanted to buy a loan on the secondary market, meaning you buy it from an individual rather than originating a new loan yourself. That's the only thing that secondary market means. And it's an annuity because it's a payment stream of a definite number of payments that is made payable to you. And so that's how the term secondary market annuity came to be. But what is this thing exactly? Well, it's a structured settlement payment right that we purchase from individuals. Now, structured settlements are payments that people receive as compensation for damages they might have had, let's say, in a car accident. And people receive monetary awards in compensation for their damages, usually through court cases. And these payments are made by they're made by an annuity that is owned by the defendant in a court case. And this annuity makes payments to compensate an individual over the course of time. That's known as a structured settlement. And then, unfortunately, for a lot of people, times change, and they need to sell their future payment rights for cash today. So let's say they have $1,000 a month for life with a certain period of months guaranteed. That's a very typical kind of award that somebody would receive in compensation for their damages. They might choose to sell a portion of their payments for a lump sum today to buy a new house or buy a new car or something like that. So that's the marketplace that we deal in. It's structured settlements that produce payments to individuals, and then individuals seek to sell their payments, and that's what we buy.
Okay. So what I've heard about secondary market annuities is that the yields are higher. Is that correct?
Yeah, absolutely. That's
Why
sort
would
of
that be?
well, as I said, these structured settlement payment rights that people sell, um, anytime somebody's in a situation where they have to sell something, sometimes they sell them at a discount, or they'll let it go for a fire sale, and that's why the yields to the investors are a little bit higher than in lots of other kinds of safe money alternatives like CDs or bonds and other kinds of instruments. So we have a really unique space in this in the financial landscape because we have A-rated guaranteed receivables that are made payable by top-rated carriers like MetLife and New York Life and companies like that, but they're selling at a discount. So it's really like getting a guaranteed payment on sale. And the yield comes from the fact that the seller out there is selling at a discount. That discount rate varies depending on the case, but typically the yield for the investor ends up being 1 to about 3% higher than comparable safe assets like CDs or other annuities. You can see that. We've got a slide on that on our website, and Vinny, I think you've got that slide as well. That higher yield. I don't know. Have you ever heard of the expression, if you've been listening to like CNBC or Fox News, and people talk about the bond market? Frequently when you hear about the bond market, they'll say price moves opposite to yield. Have you ever heard that expression?
Mm-hmm.
Yeah. So that's what's going on here. Sometimes, for a lot of people, they don't really get that until you break it down for them. But when they say price moves opposite to yield, basically something that yields 5% is going to cost a lot more than something that yields 10%. That's just sort of that's the nature of any fixed income asset like a bond or commercial real estate. The lower the yield, the higher the price, and the opposite is true too. A lower price is going to mean a higher yield. So if you're comparing what we have to like a CD, or a specific income stream, oftentimes our yield is 2 or 3% higher than a comparable asset, which means our prices can be 20, 30, 40% lower than that other asset by comparison. And all that stems from the discount that the seller is willing to take at the point when they sell their payment stream.
Would you say that secondary market annuities are safe, or is there any other sort of risk involved with the benefits that you're getting in these?
Yeah, no, they are super safe assets, and let me go back to what these things are to begin with. A secondary market annuity is an existing payment stream that is backed by an annuity that pays a payee in compensation for damages. So at the very beginning of this whole payment right, there's a court case or an out-of-court settlement where a plaintiff and a defendant kind of got together and a settlement was made and money changed hands to give the plaintiff or the person who was injured, to give them a monetary award to close out some sort of a case. So there's a legal aspect here that, in exchange for, I don't want to use the word guilt or anything like that because I don't know the specifics of the underlying court cases in many of our payments. But in exchange for the cause of the damage, payments are made. And to draw that parallel out a little bit further, if the payment is not made, and the defendant can be in a position of contempt of court, so they have to make these payments in order to close out a legal situation. A typical situation is like, let's say as a workplace injury, and somebody gets hurt at work, they can't work any longer. The employer was to blame for the situation, and they, so that the employee no longer can work. Let's say they made $5,000 a month, and they were on a career track to get 4 or 5% increase per year, and it was a lifetime career. All of a sudden, they're out of the workforce. Who's going to make those payments to that employee and their family when they can't work? that's where these kind of payments come from, and the employee might have a $5,000 or $6,000 a month check coming to him for life, with 30 or 40 years of it guaranteed, especially if they were a younger worker when these kind of things happened. So that's where these payments come from, and if the payments are not made, there's a legal ramification. So the employer, in order to close out this liability, what they do is purchase an annuity from companies like MetLife or New York Life, and this annuity makes the payment to the injured party, to the payee. So to answer your question about are these things safe, yeah, these are senior obligations of the insurance companies making the payments. There's legal ramifications if the payments aren't made, so that's why large annuities are purchased with period certain guarantees that tie to a court settlement that has to make these payments. Now, the transfer of the payments from the existing payee to a new purchaser, there's a whole lot of procedure associated with that as well that makes them very safe. There's a IRS regulation known as Section 5891, which deals with it's called the Structured Settlement Transfer Protection Act, and it deals with how a payment right is transferred from a seller to a new buyer. And a lot of the regulations in that Section 5891 deal with some of the tax ramifications for sellers and for the insurance companies when payments are transferred. But basically what that did is give my industry clear marching orders that have been adopted in 48 of 50 states. They've given a clear set of direction on how to transfer payments in a legal way that protects all parties, properly notifies all the parties, and gives the end investor who buys those payment streams a really solid foundation to rely on. So that's the long answer on how these things are safe. We've got great quality payments from great quality carriers, and we have a very clear legal procedure that we follow to transfer payments from a seller to a buyer. And we document all that stuff and are able to deliver it to you as a purchaser before you even put up one penny on a transaction. You and your attorney can see the whole thing, because these are frequently pretty good-sized transactions that an individual buyer is looking at. So we really want to make sure that they understand exactly what they're getting into. So, are these safe? Yeah, the carriers are really the thing that most buyers really focus in on. They see New York Life and MetLife and John Hancock and these incredible, strong financial institutions making the payments. And it's not often you're able to get guaranteed payments and a AA rating on basically on sale for 20 or 30% off. There's not too many markets in the world that work that way.
And that is pretty attractive.
Yeah. So these are great safe payments, and we call it a secondary market annuity, but it's not really an annuity in the sense that it comes with a lot of the restrictions that that newly issued annuities come with. But frankly, discounted receivable is not a very marketable term. Secondary market annuities is a little easier to say,
Yeah, and I think that may be, lead into my next question, where there may be some confusion about an age requirement or anything like that. Is there any sort of age requirement? Some people may have felt that in the past.
Yeah, no, that's a good point. There, with newly issued annuities, there are, you've got to be of a certain age to qualify for them. Often, if you take money out of an annuity early, it's kind of like an IRA, where you can face a penalty tax from the IRS or even from the annuity carrier. You can face a surrender penalty for taking them out earlier before their term. And that's where I go back to that, that phrase I used earlier, being a discounted receivable. These are just guaranteed payments. What we transact in a typical payment stream might be like, to use the example I used earlier, $1,000 a month for 20 years. That's exactly what you're going to get. It doesn't matter who you are, how old you are when you buy it, and it doesn't matter if you're there for 20 years to receive it either. So these are guaranteed payments. They're going to be made to you or to your heirs, and that's all documented in the court procedure that we go through to transfer the payment right to you as a new buyer. And so you don't need to be of a certain age to buy it. In fact, I've had customers as young as 17 years old and as old as 90, and neither of those kind of guys could buy an existing or a newly issued annuity. So it's a pretty neat market that allows you to do a lot of different things.
Yeah, it sounds really interesting. What about sources of funds? Are you allowed to use IRA or other types of retirement funds to buy an SMA?
Mm-hmm. Yep. Now, you deal in self-directed IRAs with your gold investors, right?
Yeah, there are a few different places out there that they do have to use typically to get approval for, like to follow the IRS guidelines to be able to store physical gold. Mm-hmm.
Right. Well, we have a similar kind of requirement that we have to use a self-directed IRA to purchase these assets. But self-directed IRAs are really interesting vehicles. They have so much flexibility. You can purchase different kinds of private company stock. You can purchase things like gold, and certain IRA custodians even allow do custodian services of physical gold as well. For us, we've worked with quite a few different self-directed IRA custodians and have the asset underwritten by several different custodians, so they understand exactly what is coming into the self-directed IRA. But there's one IRA custodian that I just absolutely love, having worked with many of them over the years. I don't know if you've ever run into Gold Star Trust, but they just are. They've become my best friends, really. I've worked with other custodians for a couple of years, and for one reason or another, sometimes they're slow. They're slow to set up an account, or they don't really, they start to nickel and dime people. And I've just come to love this Gold Star company because they're inexpensive. They understand SMAs, and they really work well with us. So with qualified funds, we've had people use IRAs, Roths, 403Bs. I've even had people who have their own pension. They have checkbook level control of their own pension through their companies. All of these kinds of qualified vehicles have been able to purchase secondary annuities, and it's pretty straightforward. You just open a self-directed account, transfer in what money you need to buy the particular asset, and the IRA custodian receives the payment stream, and then you tell the custodian what you want to do with the money. Excuse me. It's not terribly difficult.
Yeah, it sounds pretty simple. And you kind of touched on this question before. What would happen if you invested in one of these secondary market annuities and then you passed away? So what happens to the payments if you die?
Yeah.
You have this agreement in place.
Well, these, like I said, they're guaranteed receivables. So you don't buy put in $100,000 and see what the thing is going to be worth in 10 years the way you would if you bought into a mutual fund or you bought into a fixed annuity that had a rate of return. What you buy is an exact and specific payment stream. You might buy 240 monthly payments of $1,000 a month that happen on the 5th of every month. So if you're there to receive it on the 5th of every month for the next 20 years, you'll receive it. But if you do pass away, the payments are made regardless. Remember, we go back to that court settlement. Those payments have to be made in order to settle out this legal claim. So payments are made to you or to your heirs, and typically people deal with that. They do a little bit of estate planning before they buy, especially our older investors. They'll put the payments into a trust, like a living trust or a revocable trust or some sort of a family trust, or they buy in a joint tenant capacity. We find that we have an interesting subsegment of the retirement population where we have older men with younger wives, and they want to take care of their wives after they pass away. But the insurance industry and annuities in general, they really don't offer much of a payout for guys in that situation because especially if you buy a lifetime income stream, it's going to be measured on the younger woman's lifespan, and these older guys kind of get into a pickle. So many of them turn to secondary market annuities, and they'll make payments payable to them and to their spouse, and the payments get made regardless. So I always recommend that people get with an estate planner or work with me. I mean, I'm not going to offer too much legal advice, but on a general basis, we talk about trusts or wills and probate issues, depending on what state you're in, and then and we can make purchase decisions accordingly. And also, if you purchase a payment in your personal name, and then a couple of years later you put it into a trust, what's unique about the procedure that we follow is that we can change the payee on a payment stream to your business trust, to your trust, or to your business, or whoever you want to change the payment to later. It's just better to think about it on the front end. You never know what's going to happen, but yeah, the payments are going to be made, so best to think about that early on. Yeah.
Do you do that outright from the beginning to buy payments for somebody else?
Yeah. You can buy payments for a wide range of uses. I've had some fascinating situations where people come in and we had one homeowners association, for example. There was like a condo association. They're collecting dues. They need to they needed like $50,000 for a roof in 10 years into the future. And they had, I don't know, they had $35,000 or something today. What do they do with the cash today? They need a roof in a number of years, and they estimate the roof's going to cost $50,000. Well, they can buy a future lump sum secondary annuity. It's a guaranteed payment that'll mature and pay to the HOA when they need to go and replace that roof. It's a better rate of return than leaving it in CDs. There's no risk of loss to the various different participants in the homeowners association. That's a totally random application, but typically I'll see people individuals buying payments for themselves, buying payments for their kids and their grandkids. We did a large number of transactions last month for an elderly man. He was in his 90s, and he bought 20 and 30-year payment streams in lump sums to mature and pay to his kids and grandkids. He just knew he was making some extensive estate planning decisions and bought a whole bunch of cases to pay to heirs. Other people have bought for churches and charities, or using guaranteed payments to pay to themselves until such time as they pass away, and then the payments go to their favorite charity. Working with another guy who wants to buy an income stream to pay for 25 years to support his favorite lake cabin. He's leaving the cabin to a couple of his kids, and doesn't want them to. He wants them to always go to the cabin and enjoy the cabin on the lake, and not have to worry about paying for the utilities and the insurance and the TV bill and stuff like that. And so he bought one of these secondary annuities that pays a couple $1,000s a month into their cabin kitty, and going there, he just wants it to be fun for the family for long after he dies. And so that's how he's giving them the cabin, but not giving them the responsibility of taxes and maintenance and insurance. It's giving them an income stream to support it as well. It was a wonderful gift. I wish someone would do that for me,
Yeah, that's pretty nice.
Yeah. There's all different kinds of uses.
Yeah. Something that comes to mind is tax implications. What about taxes when it comes to these kind of investments?
Well, if you do your research on structured settlements, you'll find that structured settlement payments are tax-free awards to the original payee. And a lot of people sit up straight in their chair when they hear that, and they think, oh my God, can I buy this as a tax-free? And unfortunately, it's tax-free to the original annuitant. That doesn't mean it's tax-free to you as the buyer. Quite simply, the IRS hasn't ruled on how these transferred structured settlement payment rights are taxed, because they really haven't needed to, or there hasn't been a private letter ruling or a court case or anything like that. It's just like a discounted receivable. If you bought a loan at a discount somewhere, you would have a portion of each payment that the borrower made to you would be interest, and a portion would be principal. So in this situation, you're getting checks through an insurance company. The insurance company is not going to issue a 1099, the tax form that deals with principal or deals with interest income, because these payments reside within a tax-free sub-account at the insurance company level. The insurance company also doesn't know what you paid for payment stream, so they have no idea what portion is interest or principal of any given payment. So long story short, you're not going to get a 1099, but you do have a tax obligation for that portion of each payment that is interest, and that portion which is principal is obviously just return of your own money. We show all that information on an amortization schedule, which if you've ever owned a home and bought a home with a loan, you probably saw an amortization schedule with your loan. We have very similar software that allocates principal and interest across the whole life of a payment stream. And you can take that to your tax preparer or do it yourself and deal with your taxes accordingly. With IRAs, it's a little bit different. IRA qualified funds are not they're not taxed until you take money out. So we supply your IRA custodian, like Gold Star. We supply them with a year-end summary that shows the value of the annuity of the payment stream at the year-end, and they post that to your IRA account for calculation of required minimum distributions and other stuff that they do internally. I wish I could say it was tax-free, but that would not be that would get me in trouble, and it would not be accurate. So.
Okay. Yeah, some things we can't avoid,
Yeah,
situation.
Death and taxes. Yeah, it's an unfortunate reality, but.
How about reselling your payments later if you want to or have to?
People will do research. Frequently we'll get folks who've done research or online or have bought payments before in years past. And a lot of people will tell you that a payment stream or secondary market annuity is illiquid. And I would certainly advise people to consider them illiquid, but it's not very difficult to resell them if you have to. I say consider it illiquid because it's not like a stock where you can press sell on your keyboard and turn it into cash instantaneously. It can take a little bit of time to find a new buyer, and I don't know what rate you're going to sell it at. We deal, as I said, to go back to that first slide, I deal in time value of money and price moves opposite with yield. Well, if you yourself need to sell at a discount in order to get out of a payment stream, you might have to sell it at a rate that has a high yield or a low value to you, low price to you. So I always advise people to consider them illiquid, but we do have a procedure that we use through my wholesale company, which is called SMA Hub. We have a procedure which allows people to resell and transfer their payment to someone else very, very easily. And nobody else really has this, unless you're working with an advisor who's selling our stuff, who's selling SMA Hub inventory. Nobody else really does that. The court-ordered Transfer Protection Act procedure that I referenced earlier, that IRS Section 5891, that's kind of some arcane jargon dealing with transfers, but it gives the insurance companies the guidance on how to do transfers. But what unfortunately it does, the insurance companies use that regulation to make it very difficult for individual investors to transfer their payments to someone else after the fact. So there used to be a way of doing business where the end investor would be named in that court order and deal directly with an insurance company, and it was highly restrictive. Your payments were totally illiquid, and you often faced issues for heirs or putting it into a trust. It was virtually impossible to make any changes to the payee. I've even had insurance companies give me grief about trying to change an address on a payment through this court order process. Well, we devised a system by modeling some of the best in the industry who are doing this on a Wall Street syndication basis. We modeled their procedure and figured out how to create what I call downstream liquidity. And that's just a fancy way of saying, yeah, I can help you resell your payments in the future, transfer them to your heirs or to whomever else needs to. We accomplish that through the use of a trust that purchases the payments and a real top quality payment servicing company that handles the payment stream for you. So nobody else really does that, and it's one of the things that really sets our procedure apart from the rest of the competition.
So I guess up until now we've kind of discussed some of the more general topics and questions for secondary market annuities, and now we can actually get into a little bit more detail and go into some more specific types of questions that people may want to be aware of, or issues that may come up when they're really deciding to do this or not.
Yeah. This is the stuff that you really should ask your broker or your attorney if you're considering this seriously. Those kind of, the due diligence questions, right?
Mm-hmm.
Yeah,
and I guess you come at it from a kind of a unique perspective, having been in the industry for many years and a few different sides of the industry. Would you like to go into that a little bit more?
Yeah, I appreciate that because I've got a unique perspective on this. I started out in this space as a broker, what I call a best efforts basis broker, and I worked that way for years. My partner and I have a partner named Brian Anderson, and we worked through Annuities Straight Talk, and as we discovered secondary annuities, I built some other websites around them, including secondarymarketannuity.net, and over the years, I ran into a lot of issues with. I guess the issues were that it was difficult. It's a disorganized marketplace in a lot of ways, and it was inefficient. It was very hard to scale up a business when you're dealing with individual buyers and customers, and you have a long time procedure, sometimes 60 to 90 days to transact a payment between a seller and a buyer, and this court-ordered procedure that a court needs to approve the transfer from the seller to the buyer. There's a lot of notices. There's a lot of legal work that goes into it. It was just very difficult to scale up and to do a whole lot of volume in the business because transactions would come apart. Courts sometimes would not approve a transaction. Sellers wouldn't show up in court to do their part, and there were just a lot of issues that the issues all related to kind of clerical and transactional friction. It was hard to get people to move along efficiently. And so a couple of years ago, I was working with a great guy named Jonathan who was my wholesale advisor. And he said, we've got a better mousetrap in the works, and would you come join us? And so Brian and I joined and co-founded a company called SMA Hub with some guys who we were working with, and we brought a great legal counsel on board and some great clerical staff who've been with us for years. And we formed this wholesale company to serve not only our own needs as retail advisors, but to serve a lot of other advisors as well. We said, this market needs the product that we sell. These guaranteed A-rated receivables are wonderful planning tools and great assets that people want to buy, but we wanted to iron out a lot of the friction in the process. And so we teamed up with an investor and, excuse me, we teamed up with an investor and put together a legal procedure that allows us to transact these payment streams much more efficiently. And that company, as I said, is called SMA Hub. We're co-owners in that company. And we've got a great procedure there through that. And as I said, it serves advisors nationally and also allows me as a retail advisor to, I can stand behind a product now as a principal as opposed to being what I call a best efforts basis broker, which I had to be in the past. And that's sort of the old way of doing business. There are a bunch of guys out there who are still operating that way. And frankly, it's not a great, you're not really adding a lot of value for your customers. We being Brian and myself at Annuity Straight Talk, we love our customers. We have long-term relationships with our people in a financial advisory capacity, and we've kind of become part of their family. They come out to, I'm based in Montana, and we have customers who come out and visit us out here. We've taken customers on fishing trips to Alaska, and we've got a great rapport with these people. And when you're just in a kind of a simultaneous flip brokerage transaction, you're not really forming that long bond rapport that you have with people when you are really on their side of the table and working with them for a long time. So we like to work with people for a long time. I like to say, you might come in and buy an annuity from me, but I'm going to be dealing with you, and you're going to be part of my client base and dealing with you for the rest of your life, as long as this payment stream goes and there's a replacement, and then I deal with your kids, and I become part of people's financial life really when we do transactions. So the process that we follow now really facilitates that. I really enjoy being part of a company that takes more of a principal role in a transaction, and we're able to buy each of these payment streams that we resell, and that gives our investors and the agents who work under us as well, it gives them real recourse to a team that can work out any issues or find custom payment streams for people, and we're really in a good position in the industry now, and helping to kind of streamline things. So a lot of these technical questions about the transactional process that we'll get into, Vinny, there's going to be a lot of, it might sound sometimes like us versus them, but frankly, I know we have a better mousetrap, and we've got the best way of doing business in the industry, and so I'm very proud of pointing that out to people.
Great. I guess we can get into the questions. I have a list of them here. So the first one we have down is some places, do I need to put up a deposit to reserve a case?
Yep.
That would be specific to somebody who's found something they're interested in, right?
Yeah, that was one of the first things that, when you buy a home, it's not uncommon. You got to put up some earnest money to buy a house. It's good. It's good to have a little bit of, money on the table in a big transaction to make sure everybody's focused and paying attention, as in a home transaction. But the fact of the matter is, when you're working with a broker buying a secondary annuity, and if they're just in that best efforts capacity, they don't own the money. They don't own the payment stream, and they shouldn't be holding your money. They don't really have any control over the payment stream. They're just trying to flip a deal. And if you put up a deposit on a case to, quote, hold it, who are you really holding it with when you're working with a broker who doesn't really, it's not like if you're working with a real estate agent and they're just your buyer's agent, you're not going to put earnest money up with your buyer's agent. It would be a little more reasonable to put earnest money up at a title company so that the seller who actually owns the house that you want to buy knows that you've got money on the table. But our industry doesn't quite work that way. Most of these brokers who hang themselves out there selling secondary annuities, if they ask you for a deposit, it's just a game. They don't actually own the payments, and they don't. You wouldn't want to have to get into a pissing match with them to get your deposit back afterwards. I used to have to take deposits in that capacity because it allowed me, as the simultaneous broker, to look like I knew what I was doing with the sources of inventory that I would get payment streams from. And a lot of these places wouldn't talk to me unless I had some real capital, and a deposit, which I had to get from my customers, allowed me to get the attention of a seller or the originating company. Now, thankfully, we definitely don't do that anymore. We've got millions of dollars that work on any given day, buying and selling payments through this SMA Hub company that I'm part of, and all the originating sources know that, and we're a strong counterparty that we don't need an investor's money to, the end purchaser's money to buy a payment stream. And so I really am glad not to be in that position of taking a deposit, because It allows me to be in a position, and all the advisors that work with us as well, it allows us to be in a position of educating first and talking to people just in the same way I'm talking with you. We can educate people and talk to them about the whole procedure. And then when people want to move forward, they make a commitment, they do so with full disclosure. They understand exactly what they're getting into. And it becomes a much more mature transaction. I can work with individuals who know what they're going to do. I can sense on the phone by talking to them if they're real or not. And if they're not going to come forward and reserve a deal. And if they are real and they want to reserve a case and move forward with it, I don't need a few pennies in the reservation deposit to prove it.
Okay, and then the next question I have is, will I need to fund before I get closing documents?
Yeah. That simultaneous, it goes back to that simultaneous kind of role versus the principal role that we have right now. If a broker's telling you you're going to need to fund a deal right upon court approval or early on before you see documents, you really shouldn't be working with that guy. Those best efforts brokers they're really just juggling the payment stream between an originating company or a seller, and they're juggling between you and that seller, and they need your money to keep somebody happy on the other side of the other telephone line. And that exposes you to pressure to get a deal done quickly before you might have had time to thoroughly review something. And again, that's not the procedure we follow any longer at the SMA Hub inventory. We have the ability to buy each of these payment streams ourselves and resell it by a complete closing book. You get to see the whole package, you review the whole book, and after you've looked over everything, that's when you send in your first penny on a deal. And it's just much more measured and mature and calm. I like it so much better.
Yeah, it's a better process.
It really is, yeah.
And this next question is kind of like, I guess, there's a stage of acknowledgement. Would you have to fund prior to acknowledgement?
Yeah, the acknowledgement letter is a stage in the process. It's kind of the final icing on the cake or the bow on a transaction. And just so you know, like we've talked a bit about this legal and court-ordered transfer process I've mentioned a few times, but the carriers who make the payments, they are in a position where they've been paid sometimes years and years ago a premium amount to make a series of payments in compensation for damages for these structured settlement awards. They exist kind of as a third party in the whole transaction, where they're just there to write a check. They don't really, they can't dictate the terms of a deal or a transaction or a transfer. But they do need to be notified in legal, in a legal manner throughout the whole procedure. That means formal notice and certified letters and all that kind of stuff. They are a party to the court order that transfers the payments from a seller to a buyer as well. And oftentimes, the very last step, as I said, that bow on the present, is a letter, an acknowledgement letter, and it's often kind of anticlimactic. It can sometimes come 6 or 8 weeks after a court order has approved the transfer, and it's often a one-pager that simply says, "We will abide by the terms of the court order dated such and such a date." But it's really it's a final step that's really important. Very, very rarely would anything happen to derail an acknowledgement letter, but there's always that slight chance that something wouldn't come through or you don't get an acknowledgement letter. So if a broker's asking you to fund a deal before that acknowledgement letter has come in, you shouldn't do it. It's a risk to avoid. It's not a complete file. It's such a minuscule risk that it's probably not that big a deal, but when you're dealing with individuals and transactions that represent people's life savings or retirement, why take any risk at all? I mean, we're dealing with guarantees. We're dealing with guaranteed income, and you need that guaranteed outcome, that exact payment stream that you're purchasing. Why take the slightest bit of risk with it? You know, there are institutions that will fund prior to an acknowledgement letter, and in fact, our company, Hub, will sometimes fund to our vendors, our suppliers, before an acknowledgement letter, but we will never sell a payment stream to an end investor without that acknowledgement letter in place. So, you know, oftentimes people working with me, they'll get an email or a phone call from me, and I'll say, "Yep, your case was approved in court," and they get excited and they want to fund right away. And I just say, "Hold your horses. It might be another month before we have that one little piece of paper that finishes things up." And what's really nice is that our company doesn't need the end investor money to follow through and to work with the, you know, we're not playing a shell game with using one person's money to buy a payment over somewhere else. We've got independent lines of credit that handle that buffer time. So there's never any pressure on our customers to fund anything until we have a full and complete book. And like I said earlier, you know, nobody's going to send even one penny until they get a full look at the whole closing book, including that acknowledgement letter. And, you know, they may want to send it off to their attorney for outside legal review, and that's all fine as well.
Okay. The next topic would be payment servicing. Is there payment servicing?
This is a question I get pretty frequently. There's going to be there's usually two questions associated with this. Payment servicing is, first of all, it's really common in almost all different types of financial transactions, whether you really know it or not. Like when you pay your mortgage payment, for example, let's say Chase Bank has your mortgage. You're generally paying a payment servicer who handles the receipt of the mortgage payment and allocates it, and allocates principal and interest and taxes and insurance and escrows and whatever else you've got bundled into your mortgage payment, allocates that properly, and then sends the interest and the principal to the end investor who actually holds your mortgage note and probably in some big security. So payment servicing exists in the financial industry in all different kinds of ways. You know, your credit card, you make payments to a payment servicer. They serve a real useful clerical function. It's usually kind of it's like a property manager in a way. You pay a property manager, you don't pay the actual owner of your apartment if you're a renter or something like that. So payment servicing, when it's done right in this industry, in secondary market annuities, it's absolutely essential. It gives you flexibility and privacy and confidentiality, and it facilitates liquidity. And I'll touch on each of those just real briefly. With payment servicing, by flexibility, I mean if you want to give your payment to your grandchild when you die, you can specify that in your will. You can easily address that with a payment servicer. Your executor can do so, or your trustee can do so after you pass away, and boom, the payment is made to your grandchild. If you want to purchase a payment and don't really want your name in a court order, I don't know too many people who do want their name in public documents and court documents, and that's the nature of this court proceeding. In our old way of doing business, as I touched on with Best Efforts Basis Brokers, you did have your name in a public disclosure capacity right in that court order, and it was not a welcome piece of disclosure. So by using a payment servicer as the part of the correct titling, you get privacy and confidentiality in the payment stream that you've purchased. And we touched on liquidity earlier. That procedure that we follow with the SMA Hub inventory allows us to help people resell a payment in the future if they need to, or if you want to just do it yourself and sell it to somebody, you put it on Craigslist or sell it to your neighbor. You just simply notify the payment servicer that is a possibility. Now, payment servicing sometimes gets a bad rap from brokers who don't really understand the business very well, or they try and cover their tracks and tell you that it's a good thing, but they'll tell you at the 11th hour that payment servicing is involved in a case. And that's usually an awkward conversation, and I can say it's awkward because I've had to have that conversation. I've been there. A situation I'll give you an example. Let's say an individual has a $1,000 a month payment right, and they want to sell $500 of it. It's totally within their rights to sell half of their payments. But the insurance company who makes that payment might say, we will not split the check. We owe $1,000 a month. We're going to write a $1,000 a month check. And if you want to sell half of it to one person and half of it to somebody else, that's your problem. You guys go deal with it. Insurance companies frequently will do that. They'll object to splitting a payment. That's where servicing sometimes gets foisted on an end customer at the 11th hour, where a seller is in a court, literally happens sometimes in a court hearing, where the insurance company objects. They say, we won't split the check, and the originating company or the seller is going to have to quickly set up a payment servicing arrangement to take a $1,000 check in and split it and send it to two different people, two $500 checks. When payment servicing is thrust into a transaction right at the end of the game like that, it's not good for buyers and brokers who don't talk about it on the front end and don't disclose it to their customers. They're not really doing their customers much of a service. So it adds a problem there. But that kind of leads into my next point. Is payment servicing itself a bad thing? No way. It's a great thing. It does all those things that I just mentioned earlier with flexibility and privacy, confidentiality. So if a broker's telling you it's a bad thing, they're not very well informed. If they are foisting it on you at the end of the game, they're not really doing you much of a service either. If you know about it, you know exactly why you're getting it, and you're in control of that servicing relationship, it's great. It's perfect. It's exactly what you should have with a long-term asset like this that you might need future options with.
Okay, and when dealing in transactions that are this large, typically over tens of thousands or hundreds of thousands of dollars, I'm sure that a lot of people want to have their own counsel review the deal. Is that something you recommend or offer, or what would you say about that, having people's own counsel review the deal?
Yeah, it makes a lot of sense. Like, my first career was in real estate, and I started out buying homes right out of college and fixing up houses, and I quickly moved into apartments and apartment transactions, condo conversions, and then got into land development. And what was really fascinating is to go around the country. I was in Colorado originally, and then I did business in Arizona and Oregon, and almost did a deal in Texas as well. And depending on where you are in the country, attorneys play very different roles in a transaction process, in real estate at least. And the reason I bring this little parable up is that, in some places you wouldn't even dream of buying a house without, you wouldn't even make an offer without an attorney. And in other places, you do it very easily through realtors, or in other places still, it's almost all done on a for sale by owner or kind of friends and family manner. Whatever you're comfortable with, frequently an attorney will play a role in a transaction, but if you're comfortable with an attorney reviewing everything before you move, by all means, you should have an attorney look over your shoulder on this transaction as well. And we make the full collateral file associated with the transfer of a payment right totally available to outside counsel if they want to look over and verify that client's getting exactly what we say they're getting. It depends on where you are and what you're used to, if that's if that's common or not common. I'd say about 1 in 20 of my buyers do engage outside counsel. But as I said earlier, the beauty of the system that we utilize now is that I can spend a lot of time educating people, showing them sample documentation, give them, open the kimono up. They can see the whole deal before they commit to do anything and before they send any money in on a transaction. And so in that way, people get really comfortable with what they're getting into before there's any kind of a cost and a risk. And so we find that people don't really, once they get in and they understand it, a lot of them don't need to engage their own counsel, but it's totally open and available to them if they want to do so. This is a pretty specialized niche. There's there's a couple dozen attorneys nationwide who specialize in it. In each state, there are a couple of firms that act as outside counsel for the payment originating companies like J.G. Wentworth and Peachtree and other big originating firms. That outside counsel deals with the court hearings and the reviews and all that kind of stuff. And they're a sort of specialized niche practice. And then there's a smaller number of individual attorneys who do outside file review for end investors. And I can connect anyone interested give them a couple of different attorneys to work with. The cost is pretty reasonable. It's usually $500 to $700 or so for an attorney to look over the collateral file, make sure everything is complete, and then give you the thumbs up. They can handle escrow if you ever wanted to do that as well. But in our procedure, you don't send any money until your attorney's reviewed everything anyway. So there's no real need for an escrow. But what's kind of scary, I've had to deal with some investors who've come and found us who want to use outside counsel, and they operate in kind of a scared manner at first. And I come to find out that there are brokers and even sellers of payments out there who actively discourage their customers from using their own counsel. And that's a scary thing. I mean, can you imagine if you're saying, no, you don't need an attorney. Just sign here and buy the thing. I mean, come on. You wouldn't buy a house without title insurance. And in some places you can't get title insurance, so you need an attorney to review the whole chain of title and book of deeds and registry and all that kind of stuff. All depends on what you're from and where you're from and what you're used to. But by all means, open up and bring your own attorney if you'd like to. And if you don't have one, let me know. I can get you one.
Okay. Good to know.
Yeah.
And from the discussion so far, I mean, I understand that your inventory is exclusive, right? But in the notes here, it's something that any potential investor who's looking to consider a secondary market annuity, when they're talking to somebody, they should definitely find out if the inventory is exclusive or best efforts, right?
Yeah. If you ask most brokers, they may not really refer to it as best efforts, but chances are good, unless you're looking at some of the inventory that my company offers or you're working directly with me, chances are good that you are having to deal with some best efforts transactions. And in that best efforts sort of mode of doing business, that broker doesn't have any control. So let's say there's a payment stream that you really want. We'll go back to my tried and true example, $1,000 a month for 20 years. Do you really want that $1,000 a month case? You want to buy it. You fill out whatever paperwork that broker puts in front of you, and you think you have a deal, and you come to find out a week or two later, the broker's got to come to you and say, sorry, we lost that deal. And, well, why? What happened? You might get a song and dance that it failed in court, or you might get a story that its payments are not available. Unfortunately, sometimes it means that the seller sold to somebody else. If the broker doesn't really have a control or exclusive relationship to that inventory, and the seller or the originating company gets a better offer somewhere else, you might get bumped out. And that's it's no fun. A lot of times people spend a lot of time looking for just the right case, and then that needle in a haystack comes around, and they get excited and they reserve it, and then it falls apart. If it falls apart because your broker didn't ever own the deal or have control over it, you're kind of working with the wrong broker. It'd be better off to work with someone who does have an exclusive control over things. The inventory that we have through SMA Hub, you'll see it on secondary market, annuity.net or Annuity Straight Talk or any of my other websites. That inventory is all exclusive to us. There are other agents who sell it, but it's very clearly noted on the inventory what the status is and where the particular where the case is in its timeline. And those statuses are a pre-order, means that we've committed to buy that case. We're the exclusive buyer of it, and it's in the court approval process that can take 60 days or more. Once we've bought it and we have that acknowledgement letter that I touched on earlier, it'll show up as in stock. And that's exactly what it sounds like. It's in stock, we own it, all the paperwork is ready, and it can go, you can sell and settle in as quick as you want to move. We can have your closing book right away, you see all of the information, and if everything looks right, then you can close and fund the transaction. And then when cases are being marketed, there'll be some notes associated with a case in the inventory page. It'll say 48-hour hold if an investor wants some time to think about a deal, and the agent says, okay, we're going to hold this one. You can always put in a backup hold as well. And it'll also say, if a case is court approved or not, or just where it is in the transaction process. But the bottom line is, the inventory that we offer is exclusively being purchased and processed and transacted by SMA Hub, and you have a much higher chance of success with the stuff that we sell, it's such a relief, that it's very difficult as an advisor and as an investor to offer something and educate a customer and get them to select something only to have it ripped out from under you. So that's no fun. And as a buyer or potential investor of an SMA, I'd say definitely avoid that sort of best efforts channel.
Yeah, that makes a lot of sense.
Yeah.
When it comes down to the actual transaction, one of the items we have here is, do I need to be in the court order? What's your take on that? Well,
there's the court order. I think I've touched on it a couple of times on this call. There is a court procedure that we follow that is uniform in every state, largely uniform in every state, that needs to be followed in order to transact between a seller and a buyer. In that best efforts basis mode of doing business that I keep talking about, here's how the whole thing plays out. A seller of payments, like a real individual, will approach a factoring company or get solicited by a factoring company or the originating firm like J.G. Wentworth, Peachtree, that I've mentioned a few times as well. They get a seller who says, yeah, I've got $1,000 a month that I want to sell, and that factoring company then makes the payment stream available or known to a few buyers like myself. There's some brokers out there, and then there's a few buyers like us at SMA Hub. And so we'll hear that there's $1,000 a month available. We make an offer to buy it, and that's how we come up with these payments that we want to sell. It happens through factoring companies, and it happens through attorneys and various other kinds of sources of supply for us. Now, as soon as that factoring company, that intermediary entity, has a deal, they have to start the court proceeding to transfer, and we get it's a pretty long process. It's 45, 60, sometimes 90 days to get all the documents in place and do the notices properly. And at one point, a court order is prepared and submitted to the court that says, seller wants to sell $1,000 a month to, and there's blank, you fill in a blank name there. And the court needs to review all the circumstances associated with the seller, and the court rules if it's in the seller's best interest to sell a payment stream. Some brokers will tell you that, you've got to be in that court order to have a level of security. And that's just simply not true. The court order is one step out of many in a transfer process, but it's not like title insurance, or it doesn't guarantee the payment, that there's no other issues with the payment. Just because your name is in a court order doesn't really mean anything, except that the insurance company is going to make the payment exactly as specified in a court order. That's what the acknowledgement letter acknowledges. It's, yeah, we acknowledge a court order, and we'll make a payment to whoever is in that court order. What we do is a little bit different, where we put what's called a business trust and a numbered account in that court order. So it'll say Hub Business Trust, account A12345, as the new recipient of this $1,000 a month. And then we reassign to you the right to receive all the payments under that court order. You get everything associated with account Hub A12345, and you have a payment servicing contract that gives you the whole right, title, and interest in payment stream known as Hub A12345. So you have everything related to the court order except your name in that court order, and that's for all those confidentiality, liquidity, and flexibility reasons I touched on earlier. So a broker that tells you you've got to be in a court order, they're trying to scare you. It's not essential. It adds inflexibility, gives you public disclosure. Sometimes, I mean, I've even seen court orders where the end investor, not my customers, but other people's customers, where their Social Security number or EIN number is disclosed in a public document. That's horrible. Who wants their Social Security number out there? So we have to put an EIN number in the court order frequently, and that's the EIN number or employee ID number, our tax information number. That's our business trust that does that, and it offers a level of protection and confidentiality for the end investor. So like I said, we modeled this procedure from watching what the big boys in the industry do when they bundle securities for issuance on Wall Street. And we said, let's do the same quality of service that Wentworth is doing for its securities offering, but to offer it to individuals through advisors. And it works. I mean, I think we've got a great procedure, and like I said, I'm real proud of it.
Cool. I really like that setup. That's interesting.
Yeah.
So one of the next questions we have was, so if somebody's going to use an IRA, right, then they would need to help find a self-directed IRA custodian. Is that right?
Yeah. IRAs are probably about half of the business that we do, and people have money in various different forms of qualified funds. You might have an IRA or a 401k or 403 or a private, you might be the administrator of your own pension. There's so many different kinds of qualified funds out there. It's sometimes hard to follow all of them, but in almost all situations you can, unless you're in a 401k, that sometimes can be hard to roll over. But honestly, in almost all situations, you can roll over some or all of your assets from one IRA custodian to another. And we use a self-directed IRA. We need to put a secondary market annuity into a self-directed IRA in order for you to use your qualified funds. Self-directed IRA custodians that understand the market, there are quite a few of them, and I've worked with several over the years, but there's this Gold Star Trust is just the clear winner over the last few years. They're just wonderful to deal with. So some of the questions that you really should ask your IRA custodian, first of all, do they know anything about secondary annuities? Most of them will say no and won't be able to handle the asset because they simply just don't know it. So if you've gone through the gamut looking for a self-directed custodian, you've probably run into Provident or IRA Services or Gold Star. And if you're a Gold Star, skip ahead because you're already in the right place. But if you're considering Provident or IRA Services, you'll find that they've got IRA setup fees and annual fees that really can start to add up. And where things really get sticky, they start to add additional fees for additional secondary annuities. And we frequently find that people come in and buy one case to begin with, but then they might buy 3, 4, 5 more cases or payment streams in their IRA. And if you've got a custodian who charges a little bit for each new case, maybe $50 or $100 onboarding fee for each new payment stream, that really starts to add up. Another place where IRA custodians get you is when you need to take money out. That's entirely at your discretion when you take money out. So you don't have to do this, but if you buy a monthly payment stream and you want to get a monthly check out of your IRA, some of them charge $10 just to get an ACH out. That was a bit of a shocker. Gold Star doesn't charge that. It's free withdrawals out by ACH, and so that's a huge win right there. And then, of course, there are some custodians out there who want to charge for assets under management or a percentage of the value of what you've got in your IRA. And frankly, that's a non-starter. Just don't even go there. I mean, I've seen self-directed IRAs that are $500-600 a year, and that's crippling. That's just too much money for really all it needs to be is just a bank account that complies with Uncle Sam. And IRA or Gold Star Trust's self-directed IRA is just a clear winner. So happy to, I don't get any benefit from referring Gold Star except great service, and I know my customers are taken care of. So this is one of those recommendations that's just wonderful to make because it's a great company to deal with and freely offered and well-deserved recommendation.
Great. So who would you say, people are considering maybe buying an SMA, but who would you say is not a good match for, in your opinion, for getting into this type of investment?
Well, my world is we kind of approach the investment landscape, and people who are coming to us, they all have a need for some sort of a guarantee. Not everybody is in that particular mode, but the typical person who I'm looking for, who is looking for an SMA, they don't want market volatility. They don't like the fact that their investments can lose money, and they like the idea of a guaranteed outcome. So guarantees are really the main selling point. We're dealing with, AA credit companies like MetLife, and you're buying guaranteed payments, lump sums, or income streams at a discount. And so that's sort of the broad brush of who these payments are for. If you need a lifetime income stream, like one of my better customers is a guy who was in his mid-50s, and he knew he was going to live to be 100 or more. He just was in great health, and the first thing he did was buy lifetime income. He bought longevity income contracts, which basically didn't start paying until he was 85, and they paid for life, but on that tail end of life. It's like longevity insurance. And the guy got a tremendous amount of money coming in, not till he's 85. Well, he took care of his longevity. He knew he needed lifetime income. He took care of that first, and then came back and started buying secondary annuities to get him from where he was today, retired, to 85 when that lifetime income came into place. He put together an incredible plan for himself that has great guaranteed income. He left a lot of money on the sidelines for other investments, and he's living the dream right now. He's in his late 50s and has all the income he could possibly need. So if you need lifetime income, take care of that first, or think about it, or buy a secondary annuity that matures at a time in the future so you can buy lifetime income. It's important. For most people, it's important. For some, it's not. If you feel like you're going to need your money for emergencies, or you don't have a whole lot of assets and you want to get into the SMA business or get into the market a little bit, but you might need to cash your SMA in, don't do it. I can facilitate the liquidity. I can help people resell payments, but it might cost you some money. It might not happen quickly. And the last thing I would want anyone to see is to them to put themselves in a cash flow crunch because they bought an asset like this that it's got limited liquidity. So if you think you're going to need the money or need to surrender the contract, don't buy the SMA. But for people who really like the idea of a guaranteed way to accumulate money, both in cash or in their IRA, if you think you can do better somewhere else with the same kind of credit, don't buy the SMA, but tell me what it is. If you can find something better out there, let me know. We have found this to be just an incredible asset, and our customers all over the country love them. They buy them. People come back. And really the telling thing is that people frequently come in, they'll buy one case, kind of dip their toe in the water, and before you know it, they've bought, they come in and say they want to spend $50,000, and before you know it, they've spent $300,000 or $400,000 on 5 or 6 different cases. It just happens over and over again. It's a great market. It's small. It's not too good to be true. It might be too good to last too long. And so if you're interested in it, get in. Let's take a look at the inventory and have a conversation of how they fit in for your needs.
Excellent. Well, Nathaniel, I just want to really thank you for taking the time to answer these questions and kind of give us a good overview and some questions to ask and things to consider. in this market, this secondary market annuity niche. So thank you so
Vinny,
much.
Vinny, this is just great. I really appreciate you taking the time to do this and share it with your folks because, there's a world of possibility out there in this little space for the right kind of independent-minded investor, and really happy to help them out and appreciate you sharing it with people.
Great. Well, that's all we have for now, so I guess it's time to go, but thank you again.